The job market is cooling down, but it is not collapsing. And that may be the worst possible setup for mortgage rate. Because if the labor market was clearly breaking, the Fed would have more reason to cut rates. But if the labor market is still holding up, the Fed can wait. That's a problem. The economy added 115,000 jobs in April. The unemployment rate stayed at 4.3. That's not a booming labor market, but it is also not a collapse. The economy is not strong enough to make people feel comfortable, but it is not weak enough to force lower interest rate. That puts a home buyer in a very painful middle zone. Jobs are slowing, wages are cooling, but unemployment is not surging at all. And because inflation is still above the Fed target, the Fed may not feel enough pressure to cut. So this video is about the labor market trap. First, we'll talk about what the latest job report showed. Second, we'll explain why not terrible job data can actually keep rate higher. Third, we'll talk about the wage growth and inflation pressure. And finally, we'll explain why this matters for Treasury yield and mortgage rate. Let's start with the job report. In April, the US economy added 115,000 jobs. That is not a booming labor market, nor is it a collapse. And that is what matters. The unemployment rate also stayed at 4.3. So if you're the Fed, this report does not scream emergency. It does not say that the economy is falling apart. It says that the labor market is still slowing but not holding together. That matters because the Fed needs a reason to cut rate. If inflation is too high and the jobs are still okay, the Fed can wait. And that's why this job report may not help mortgage rate very much. It is soft enough to show the economy is cooling, but it is not weak enough to force the Fed hand to cut. This is the part that sounds backward. Sometimes okay economic data is bad for mortgage rate. Why? Because okay data gives the Fed permission to wait. If jobs were collapsing, the Fed would be under a lot more pressure to cut rate quickly. But if jobs are just slowing gradually, the Fed does not have to rush. And if inflation is still above the Fed target, the Fed has even more reason to wait. That means okay job data can keep interest rate for higher for longer. That's a trap. The labor market is not strong enough to make the economy feel amazing, but it's still strong enough to stop the Fed from panicking. So home buyers do not get the benefit of a strong economy. They also do not get the relief or quick rate cut. They get stuck in the middle. That's why this job market is very frustrating. Now, let's talk about wages. Wage growth is important because wage can feed into inflation. If wage rise too quickly, business may raise price to protect margin. And if price keep rising, the Fed has a harder time to cut rate. The Atlanta Fed wage growth tracker show wage growth around the mid 3% range. That is cooler than the harder labor market period. But it is not a labor market collapse. It still shows workers are getting pay increase. It still shows that labor market has some strength. And for the Fed, that means they may not be able to declare victory yet. This is why wage data fits the same pattern. It is cooler, but not broken. It helps inflation story a little bit, but it may not be enough to unlock the fast rate cut. So how does this connect to mortgage rate? Mortgage rate are closely tied to the Treasury yield, and Treasury yield needs a reason to fall. A clear recession scare could make you fall. Clear inflation progress could make you fall. Clear Fed rate cut could make you fall. But a labor market that is okay does not give the bond market a strong reason to move lower. Instead, investors may say the economy is slowing, but not enough for the Fed to cut rate aggressively. And inflation is sticky, the investor may demand higher yield that keeps mortgage rates sticky. This is why homeowners can get frustrated. They see headlines saying that the labor market is cooling, but mortgage rate do not fall much. That is because the labor market has to be weakened enough to change the Fed reaction function. And right now, it may not be there yet. So here's a full picture. The job market is cooling, but it is not collapsing. Payroll are slowing down, but it's still positive. Unemployment is not surging up. Wage growth is cooling, but still around the mid 3% range. And that puts the Fed in a very difficult position. If inflation is still above the target and the labor market is still holding together, the Fed can wait. That means rate cut can be delayed. Treasury can still stay elevated, and mortgage rate can stay sticky. So the problem for home buyers is not just a strong labor market. The problem is a labor market that is weak enough to create uncertainty, but strong enough to delay the Fed rate cut. That's the worst middle zone. Too weak to feel good, too strong for any rate cuts. And that is why this job market may keep mortgage rate higher for longer. That's all for today. That's my outlook on the mortgage rate based on the labor market trend. Thank you for watching.